With mortgage renewal dates fast approaching for many of you, I totally understand that there's probably a mixture of feelings between stress and concern and what it actually looks like for you going forward. This is going to be a crucial financial decision for you that will affect your future. In this video, I'm going to guide you through some real life examples and also some tangible steps that you can take in order to help you navigate this a little bit more clearly and really give you a better peace of mind when it comes to deciding on how you need to kind of move forward in this decision of mortgage renewal and the process it entails. Canadians are in shambles with rising interest rates and what that actually means for their finances. As highlighted by one CBC article, Canadians are coming to mortgage brokers in tears over the fact that a lot of them, they have their variable mortgage rates causing an extra $1,000 a month in payments simply towards interest, not even towards the principal itself. This is a result of the high and fast rising rates that we've seen over the last 12 months. Fixed mortgage rate holders are also going to see a pretty significant rise to their payments on a month-to-month basis or bi-weekly basis, or however you have your mortgage payments set up. You're going to see a rise to the overall monthly payment once you renew because of these increased interest rates. Now, obviously, I don't want to just cause some concern, but I want to highlight some options that we could look at and really dive into a few scenarios where we could see paying off your mortgage in a different way or maybe looking at some alternatives as well. So let's just dive right into it. Now, the scenarios I'm going to show you might not specifically apply to you, but the overall concepts are going to be probably fairly similar to what you're facing in your own financial lives. I'm going to jump into a base scenario where it's just showing you what a couple who are both 45 years old and kind of showing you what debt and interest really has and how that impacts their lives. So looking at Mr. and Mrs. Young, I'm sure if you've watched our videos before, you've seen them in the channel, and I just kind of want to highlight a couple things on the personal side. So Mr. and Mrs. Young have a debt or a mortgage balance of $600,000 as of this year, and with them kind of solidifying their fixed mortgage rate a couple years ago, they've got a 2.5% interest rate. So their monthly premiums or their monthly payments on this are $3,750. Now, if we look at the actual planning side of the page, you can see in the debt mortgage column that this being half of the expense on Mr. Young's side, half on Mrs. Young, they're going to be paying this down at $45,000 a year. And these payments are going to stretch across another 15 years, so 15 years of amortization. And if they were to have this 2.5% ongoing, this would remain the same. So obviously, if you were to renew your mortgage rate today, that won't be the case. Now, let's dive into option number one. And this one, simply put, is just stomach the difference in the increase of your mortgage payments. So you're going to need to be paying more on a month-to-month basis in order to keep your 15-year amortization period and have that paid off in the same amount of time. So this might mean saving less into your various savings accounts, your RSPs, your TFSAs, non-registered accounts. You'll have to save less there in order to cover the interest now owing above and beyond what you were used to paying before you saw this interest hike. Now let me show you what that actually looks like on the planning software. So in Mr. and Mrs. Young's case, I haven't actually adjusted their spending at all, but I have adjusted their savings in order to account for the increased interest owing. So you can see here that previously, again with the mortgage balance of $600,000 at 2.5%, they were paying it down at $3,750 a month. Well, if you were to renew January 1st of next year and they saw their interest rates rise up to 6%, then they'd actually be needing to pay an extra $1,100 a month just to keep it in line with that 15-year amortization period. Now in the base scenario, Mr. and Mrs. Young had $1.44 million million built up of invested assets or TFSA, RSP, non-registered balances to kind of cover their retirement from there on out. Whereas in this scenario, due to that increased interest and not being able to save as much, they've actually dropped their savings by $220,000 at age 70. So this does allow them to obviously stay in their home and can keep the same amortization period, but they are going to see a resultingly less amount of savings built up by the time that they retire in order to basically keep up with the current mortgage payments that will be due when they renew. Now let's look at option number 2, and that concept is basically just increasing your amortization period. So Mr. and Mrs. Young in this scenario are actually going to keep the same month-to-month payments that they previously were, so $3,750, meaning that they can keep saving as they were previously in their various accounts. But in order to do this, they need to re-amortize for an additional 10 years of what they currently are doing. So instead of 15 years, they're looking at 25 years of mortgage payments occurring versus the 15 years which we saw in the previous scenario. Again, as you can see, I haven't adjusted their spending at all, and I haven't adjusted their savings from the original scenario. The only thing that will be changing is the actual mortgage payments themselves. So as noted here, with the renewal at 6%, we have monthly payments of $3,750. But again, this does add an additional 10 years to their payments, leading into retirement then. And I'm not saying this is the best option for everyone, and it's gonna really depend on the numbers, but in this case it actually benefited them slightly to increase the amortization versus just increasing the payments on a month-to-month basis. They were actually able to save an additional $40,000 versus the other strategy of just continuing their amortization period and paying the additional amount on a month-to-month basis. Now the final scenario I want to look at today is probably not going to be accepted by many, at least very welcoming to most, but it might be necessary for many of you, and that is downsizing your home. So in order to keep the same amortization period and in order to keep the same amount of mortgage payments, you're going to need to decrease the debt owing on your home. And in order to do that, you'll have to downsize. So again, this might not be the most welcomed option, but if you're looking to potentially downsize in the future, or you already have a home that is too big for you, or you just don't feel the need to have that size of a home anymore, this might be the right time then to start looking at decreasing the debt owing on your home in order to continue living the way you previously were prior to these interest hikes. Now in this final scenario, in order to do all that, this couple, Mr. and Mrs. Young, had to downsize their home by $145,000 in order to, again, keep the same amortization period and keep the same monthly payments, and ultimately allowed them to continue saving as they once were and have the same amount of savings built up for retirement when they chose to do so. I'm sure many of you are going to struggle with this video, mostly because it hits close to home, but also because you might not like the options I presented in front of you today. But ultimately, that might be the only option for you because of these rising interest rates, creating mortgages almost unbearable. And now for those of you who haven't entered the housing market yet, do your due diligence, understand that can you afford your mortgage if it goes up by 3% and the next time you renew, or are you going to be struggling and in the same position that we've seen others in the past? So do your due diligence, make sure you understand what a stress test means for you and your monthly budget in order to make sure that you're always on the right foot and always kind of head above water when you're working through your finances. At the end of the day, my biggest suggestion is work with your financial planner and your mortgage broker to understand what the best option is for you, whether you're renewing or purchasing for the first time.